Welcome to the Essay Update, your source for insightful conversations and timely topics designed to educate our clients and strengthen our communities. I'm your host, Mike Schuster. And today I'm thrilled to have Dr. Ernie Goss from Creighton University as our guest, our special guest. Dr. Goss holds the Jack A. McAllister Chair in Regional Economics, and he is the mastermind behind the Rural Main Street Index, which we're going to talk to him today about. It's a monthly pulse on rural America that is quoted everywhere from the Wall Street Journal to RFD TV. With a PhD from the University of Tennessee, Dr. Goss is also a military veteran like myself, so thank you for your service, sir. And his regional economic report hits 75 to 100 radio stations. We're digging into today what's going on here in rural America and rural Nebraska. And a lot of you have been asking me questions. And so, Dr. Goss, welcome to our podcast. Thank you for joining us.
Oh, thank you, Mike, and good to be with you. Of course, a mastermind. I want to give Bill McQuillan, who lived in rural Nebraska. He was head of the bank there. It was his idea for the Rural Main Street Index. He and I put our heads together, and this is what we came up with. And Bill recently passed away, so I don't want to take any credit away from Bill. It was a great idea on his part, and I think we at Creighton University sort of carried it out, but a lot to do with him. So thank you for the introduction, Mike.
Yeah. So Dr. Goss, let's start with that Rural Main Street Index, which I'm fascinated by. Start first with what makes up that index itself, and then talk about it dropping so much and the aspects of it dropping here recently.
Well, it's been dropping for some time, Mike, and it's the makeup of it is we ask an overall question, and that's what we call the Rural Main Street Index, and it's been below growth neutral. The number ranges between 0 and 100. 50 is growth neutral. It's been below growth neutral for 18 of the last 19 months, so that's a long way. And what is happening, and no surprise to your audience, it has a lot to do with grain prices. I mean, the livestock prices have held up pretty darn good, and those who depend on livestock prices have been doing, particularly beef, of course, pork not as strong. They've been doing quite well, but on the grain side, not so well. Those prices, whether it's corn, soybean, and wheat, the three crops most focused on in this part of the country. And this is a survey, by the way, of bank CEOs in rural areas of 10 states. So the bankers are speaking for what they see in their area, their banking area, and it's all dominated by agriculture or energy. We survey Wyoming and Colorado as well. So out there, it's a lot more energy and less agriculture.
I'm going to segue to a different subject in rural Nebraska or outstate Nebraska or some of the places you cover, and that is labor market. And one of the things that we struggled with last year, a lot of us serve on nonprofit boards or do other work out here, is a very low unemployment market to the point where it's driving wages up. I want to ask from a different angle. What do you think improves this labor market where we can get more workers out here? Is that immigration reform? Is that a softening economy? What is it in your mind?
Okay, two of them. Immigration reform, yes, very high on the list. Secondly is housing. I just got a call from an economic developer in not a rural area of Nebraska, but an area of Nebraska, not an urban either, talking about, well, how is housing? Housing is a big issue when you have a trailing spouse. For example, in Auburn, Nebraska, down with the nuclear facility there, you may be the CEO of that nuclear facility, but you may have a trailing spouse and he or she's got to get a job in that local area. That is a real impediment. So that's a big impediment. Another impediment to the labor markets is childcare in rural areas in Nebraska. And then the third one you brought up, immigration. If we are open to immigration, now legal immigration, legal, not illegal or undocumented. I'm talking about legal immigration. We are a big beneficiary. And right now, there's not, I was a faculty member at Cal State Fresno, which is a big agriculture area. They're much more labor intensive agriculture. Here we're capital intensive, so labor is not as big of an issue on the farm, but it's a big issue for farm products, for example, food processing. There it's a big issue,
Yeah.
and we could be successful in getting those men and women to move here and work here, and we've been successful with that.
It was interesting that you started with housing because a lot of the communities we serve, housing is a huge issue, and so it was very interesting you started with that. So if you were to give advice to a lot of these rural communities, you would probably encourage their local economic development corporations to develop more housing or housing projects. Would that be a fair statement?
Oh, absolutely. And some of the cities have done that very successfully. So you could have a house, as we did with back in the 19th century with land that individuals were given or provided land as long as they stayed there for a certain period of time. Likewise, a housing, and it is well worth the money. And one thing I'd like to advise against, I teach students. I've been teaching them for a long time. And the idea that somehow we have this economic development mindset, the world is governed by young guys and gals. You got to get these young guys and gals. Wrong. What we have to get is those men and women, those families who decide to make this their home. And when they wish to get away from the crime of certain cities, they want to come to Nebraska. Nebraska is a great place, as are our surrounding states. My daughter, who lives in Denver, she wants to get the heck out of there because of
Hmm.
crime.
Hmm.
Well, St. Louis, I mean, even Omaha is a low crime city.
Yep.
We have a good life, and that's the term. It's the good life, and we can be successful. But back to your question, yes, providing housing. Now, I'm not always keen on some of the TIF housing, the construction and TIF awards there. We need to be careful with those. I won't say giveaways, but we need to be a little tougher, making sure that the recipient follows through on that development.
So let's go from a historical perspective on this from a housing standpoint. If you study, the results of housing and it used to be in the past, municipalities used to do have a lot more to do with, helping developments go. If you're not going to go with TIF, what makes housing more affordable for people and how do municipalities do that to recruit people?
Well, I'm certainly not an economic development actual on the ground. I mean, I'm a
Hmm.
theoretician, and I'm sure your audience say we
Yeah.
don't need it. We've had, as my brother used to tell me, we've had enough of theoreticians here. I need to build a house, and my brother built houses. And as far as doing it, there can be certainly methodologies. The problem we're having and going to have is the ability to get anything from the federal government that's waning as you and I speak today. And that's not such a bad thing. We don't need the federal government there. But the idea of putting your money, I think, again, put it on what we're successful with. And we're successful with families, with older meaning over 30. I mean, for me,
Yeah.
I have a
Yeah.
class of that we can't even go out for a beer. And not there's nobody in the class. They're all under 21. So anyway, yeah, I mean there's a certain, and the idea that the old economic development adage, shoot everything that flies and claim everything that falls, that won't work in Nebraska. We have to focus our economic development incentives and go after the profile of individuals that we've been successful with. There's nothing wrong with being successful.
So should the Fed be cutting interest rates? There's a big dilemma right now of the whole, should they hold rates where they're at for inflation purposes, or should they be cutting because we have a reinvestment risk too of what is the number 9 or 10 trillion this year that we have to
Absolutely.
refinance. It's going to increase our costs. So I mean, what are your thoughts there?
Well, I think the Fed's caught between a rock and a hard place. They need to reduce rates because of the burden on the federal treasury. Paying the interest now on the debt is over $1 trillion more than the Defense Department's budget. So but they can't cut because there's too much inflationary pressures in there. So, but I think there will be a cut because the economy is slowing down. We'll see the first Friday of the month in April. The jobs numbers, I don't think they're going to be that strong. So we're going to see, but unfortunately, most of your audience in my class, and my classes forever, almost, they are so used to low interest rates. They think a prime interest rate of 5.5% is high,
Mhm.
not by historical standards. Right now, interest rates are about the historical mean. The idea that these are high. No, first house I bought in 1983, I paid 10.25% interest on it. If I did that now, the president of Creighton University would want me fired. I'd be an
Mhm.
idiot. I mean,
Yeah.
nobody. I mean, the yield now is the interest rate on the mortgage is below 7%. I think it's going to move even lower this year, but it's going to move higher long term. We got to get used to higher interest rates because the federal government is spending way too much, and they will until they face up to the 10-year treasury. Back to the gap between the two, when the 10-year treasury yield begins to rise, watch out, something's going on, and what's going on is too much inflationary pressures in there. So you could have both yields going up, but the yield on the junk bond should be going up faster than the 10-year treasury.
Which is a good
10-year
point.
treasury.
Do you feel like the bond vigilantes come out this year? Because we've seen the 10-year treasury bottom around 4.8, or I'm sorry, 4.18 here
Right,
recently, and today it's at 4.30. So
right, right.
as today we shoot this this video. So I mean, do you think that we see a 5 to 5.5% 10-year?
Yeah, we will, but not this. I don't think we're going to see it this year. I think it's going to bump along. It's the safe haven buy right now. I mean, you got gold is running up there. Why gold? Safe haven. There's some safe haven. Also, the price of gold now is approaching $3,100 an ounce. Is it
Mhm.
going to move higher? Yes. Will the 10-year yield move higher? Yes. But it's going to bounce along up and down. The volatility this year is going to be extreme, and the 10-year treasury long term is going to go higher. Now, in this environment we're in now, it's up and down, and the mortgage rate, as you know, is tied almost directly to the 10-year treasury.
Correct.
So the 10-year treasury moves up, the mortgage rates move up. Well, as you said, the 10-year yield has gone down. Is it gonna, we were up close to 5% on the 10-year treasury, and it's come tumbling down. Why? Because growth has come tumbling down for one reason. Also, safe haven buying. A lot of investors are gone in. Look at the market. Look at the U.S. market. It's overpriced. Come on. I don't need, I'm sure you know that. Well, you do know it better than I.
So tell me about what brings the housing costs down then. If you're talking about interest rates going up, what's going to bring that down? Is it going to be government trying to build infrastructure? I mean, more labor? What is it that brings the cost down?
I think the cost will come down when we have a calamity like we had in the Silicon Valley Bank. No, March of 2023, we had the Silicon Valley Bank, Signature Bank, First Republic essentially went under. Well, the Fed bailed them out, the Treasury bailed them out. We're going to have to see some big time bailouts. And what's going on right now in Florida? Look at those home prices coming down. They're coming down in Georgia. So those prices are going to come down, but we're going to have to see a calamity. Now, what would a calamity be? Would be a failure of some banks because of their focus on residential real estate. That could, but that's most. I don't see many. Not in this part of the country. You don't see many bankers focused on residential real estate. They're more focused on obviously farmland and other issues. So,
Well, so the bigger picture question would be, and this is since we went down this road, is so the insurance companies or the states that keep insurance rates low artificially, and basically that plus the states that keep property tax rates low, as they start to increase, then that brings those prices down in your mind. Is that what you're kind of saying in this case?
oh, absolutely. Mike, I'll give you an example. I back in the last Great Depression, it's called GFC, Great Financial Crisis. I bought sight unseen. I bought 12 houses, I think it was, and
Hmm.
I got them for, I got them for $20,000, acre of land, 2 acres of land, all brick, two bedroom, three bedrooms, two baths, 20,000. All right.
Oh,
So now, believe it or not, those I still own those houses. I have property managers, and I don't fool with it. But I fool with it now. I'm doing my taxes and I'm losing money on those houses. Why? Because of insurance costs have gone up, uh, property taxes have escalated, skyrocketed, and I'm telling you, nationwide, you got some big uh, buyers of property that bought. That would be BlackRock, for example. And they went into these communities and bought up housing, and now they're hurting. They're hurting like as I'm hurting. I have low basis. Their basis is a lot higher than mine, and they're hurting. They got to be hurting. So what's going to happen is they're going to dump those houses on the market, and they've already dumped them in Austin, Texas, dumped them in Arizona in certain parts, Florida, Georgia in some parts, Alabama to a lesser degree. Not in this part of the country, not yet, not yet.
So do you think we have a housing shortage nationwide, or do you think, because there's that theory
Yes,
that we're underbuilt? So you're
yes.
still saying that we will still see prices come down even though we have a shortage, correct?
Yes, yeah, exactly. Yeah, I
Yeah,
mean, ultimately, now they've been going up. I mean, it's defied my prediction. I mean, the housing affordability is in a record lower high. In other words, they're unaffordable.
right.
Um, when I bought my house, I was a young guy, and I couldn't do it now with that pay I got it when I was that age. Nowadays you couldn't buy it. Couldn't buy
Mhm.
it. And that house I bought, first house was $43,000. You know what you get for 43,000 now? Not good, not much.
Yeah,
And the mortgage rate is high, but still, it's still 7%. Now, when I bought that house, it's 10 and a quarter. In other words, people they're going to have to get used to higher interest rates,
yeah,
and I'm not sure we're there yet. But housing, we're going to see a break in housing, and there are two overpriced sectors in our economy. Stock market is overpriced, no doubt about it. Whether you use a Buffett indicator, you use PE ratios, all of it's overpriced. But so it brings up, you got to be doing trading. You have to rely on, you can't do ETFs. ETFs got to depend on an advisor. An advisor knows how to pick these stocks. I'm not one of them. So you need an advisor to help you. This is a
yeah.
market you don't want to be jumping into without some help. And if you don't know the difference between a bond fund and a bond, you need help.
Yeah,
You need
absolutely.
help.
And you raise a really good point of the relationship between interest rates and housing prices. There is a correlation, just like in bonds. So, I greatly appreciate your time. I know you're on limited time today, as I am too. But we really enjoyed the conversation with you today. So thank you, Dr. Goss, for coming today or joining us via Zoom today for our podcast.
Well, thanks, Mike. It's a great time to be alive, and as the Chinese, it's a curse, but I look at it as a blessing. May you live in interesting times. We are living in the most interesting time ever. Thanks, Mike.
Thank you.